The average rental yield of a well-located property in Australia sits around 5% or so. So if you own 1 million worth of property and have zero debt, you will get $50,000 gross every year from that portfolio. You will then have to pay taxes, property managers, and repairs. This will leave you with about $40,000, and then you have to pay taxes on top of that. So if you want a net annual income of 100 grand, you need a property portfolio that can generate gross annual income of 150 or so. This portfolio would need to be worth 3 million, and it has to be debt free. Not to mention your own home, it also has to be debt free, otherwise you're going to have a mortgage and that will affect your actual net income at the end of the financial year. So you probably need to chuck another 2 million on top of the 3 in order for you to create that passive income of $100,000 a year. So the question that I want to ask you, can you save your way to $5 million? I know I can't. Let me ask you another question. Will you ever build a property portfolio that's worth $5 million on a few dollars a week of positive cash flow? In this video, we explore the importance of leveraging and compound growth for your property portfolio. Hi, my name is Roy and welcome to Roy Talks Property. On this channel, we discuss everything related to property investing, property finance, and the different strategies available for you today to build wealth through real estate. If that's of interest to you, make sure you subscribe to my channel and click the bell icon so you can get notified every time we upload a video. Your support is greatly appreciated. Most average landlords want their property portfolio to replace their income, but most of them don't have a clear strategy to help them achieve this goal of financial freedom. They just buy a property or two and they hope for the best. Hoping has never worked for anyone. And if you think that you can live off the rental income of your properties within 10 years, you're dreaming. It's not that simple. It's very hard to build a property portfolio with enough cash flow positive properties to help you replace your income. So let's talk about what serious property investors do to achieve financial freedom. In the first stage, they acquire as many high growth properties as possible. Then they focus on lowering the loan to value ratio, better known as LVR. In the second stage, they then focus on managing that portfolio and taking out cash flow from that portfolio. So here are some ways that you can lower LVR. They acquire multiple properties in high growth locations, and then they stop buying properties altogether and they wait for the market to do its thing and for their portfolio to grow in value. Number 2, they manufacture equity through renovations or small developments. Number 3, they build 2 property portfolios, one under their personal name and another one under their self-managed super fund, and then they use the self-managed super fund to pay off the personal debt that they have. And the fourth one, which is a very obvious one, they liquidate a few properties to pay off the others. And the hardest part about this is to find properties that will appreciate in value in time and can support you along the way. One common denominator across all property investors that I meet is that they want to live off their investment properties. That's normal. So here is one way serious property investors live off their investment properties. They target a loan to value ratio of 40 to 50%. This will allow you to have some cash left over after you pay off your mortgage and your running costs. This gives you serviceability for future debt. At Buyers Club, we call this property portfolio the golden parachute. And if you want to find out how we can help you get started with this property portfolio, reach out to one of the links below. We'd be more than happy to chat. We will assume that the property portfolio is worth 5 million and you owe 2.5 million. We will also assume that the rental yield from your portfolio is 5% and that it's growing at an annual rate of 7%. Keep in mind that the equity that you release from your portfolio is tax-free because it's debt, not an actual income. So let's have a look at this scenario. You own a property portfolio that's worth 5 million and you owe 2.5 million. At a 6% interest-only repayments, your annual repayments would be 150,000. At a 5% rental yield, your income, your gross rental income is 250,000, and that will leave you with a gross income of 100,000 to pay your property manager, running expenses, and then some cash left over positive in your pocket. Come 2024, your portfolio grows at 7% rate, and that means now it's worth $5,350,000. What you're going to do is you're going to pull out $150,000 worth of equity as cash. Now your debt has gone up from $2.5 million to $2.65 million, and your repayments at a 6% interest rate are now $159,000. Because your portfolio has gone up in value, the rental income has also gone up in value. At a 5% rate, you're looking at $267,000. That means your gross income from the cash flow of your portfolio is $108,000 plus the $150,000 of equity that you pulled out. That will give you a gross income of $258,000 a year to live off. Let's move on to 2025. We repeat the same exercise. Your property portfolio has gone up from 5.35 million to 5.725 million. And now you're going to pull out another 150,000 from your portfolio, and your debt is going to go up to 2.8 million. Your repayments are now 168,000, and your rental income has also gone up to 286,000. Your gross income is 118,000 from the rental income and 150,000 from the equity that you released. So your income is now 268,000. So as you can see, this stage is about managing cash flow, and this is why we call this portfolio the golden parachute, and your feet never touch the ground. Does this scenario work? 100%, but on one condition: time in the market, not timing the market. Real estate has always been long-term. And if you think that it's enough for you to rely on your super for a comfortable retirement, make sure you check out this video. Thank you so much for watching, and as always, if you received any value from my video, please like and share the actual video, and don't forget to subscribe to my channel, and I'll talk to you next time.